Welcome to the NAB Regional and Agribusiness Economic and Property Mid-Year Update. I'm Alison Blanchard, State Business Bank Executive Queensland, and your host today. I'm joined by NAB economist Leah Jurkovic and Executive Director of Heron Todd White, John McKillop. Thank you both for joining us. Before we begin today, I'd like to acknowledge the traditional owners of the country on which we meet today. I acknowledge the traditional owners of the lands we govern, the Turrbal and Yugara peoples, and pay respects to their elders, past, present, and emerging. Today, we plan to share a robust 30-minute conversation about what's happening across the Australian and global economy, key drivers that are impacting businesses, especially in regional Australia, followed by a more focused look at what's happening in the property sector in regional Australia. We'll then open it up for Q&A. As I travel around Queensland, I speak to a lot of customers, and I always feel inspired by the positive mindset of business leaders, no matter where they are in the economic cycle. They're always finding better ways to do things and looking for opportunities everywhere. I'd like to start with a few headlines on how the property sector is travelling overall in regional Australia. Firstly, in regards to residential prices, they've risen about 7% in the last year, dominated by WA, South Australia and Queensland, with somewhat softer growth in New South Wales and Victoria. In regards to commercial property in regional Australia, it's held up relatively well, with industrial properties still the shining light, whereas investment assets like retail and office have somewhat moderated, with interest dominated by owner-occupier and local investors. In regards to agribusiness properties, it's somewhat normalised, with the quality properties still sought after, but secondary properties are showing somewhat softer demand. Before we get into today's discussion, I'd like to introduce John McKillop. John has numerous roles in the agribusiness sector over the past 25 years, including CEO of Hancock Agriculture, Hassard Australia, and Clyde Agriculture, as well as non-executive roles such as Lord, Dairy Farmers Milk Cooperative, Dairy Australia, and Meat and Livestock Australia. His current roles include Chair of the Red Meat Advisory Council, Manor Estates, Compass Agribusiness, Black Box Company, and Executive Director of Agribusiness for Heron Todd White. John has offered to provide an expert view and perspective on what Heron Todd White is seeing across the property sector. We'll hear from John shortly, but let's get into the discussion, starting with Leah, our NAB economist, to give us the NAB view on what lies ahead globally and domestically. Over to you, Leah.
Thanks very much, Alison. So I'll just quickly share my presentation with the audience. Great. So as Alison said, I'm going to be talking through developments in the global economy. So what's happening with growth and with inflation, and also what are some of the risks around the outlook, supply chains, geopolitics. I'll then focus up on the Australian economy and just chat through what we're seeing at home. So what's happening with growth, what's happening with inflation. Of course, I'll get to what that means for the RBA and finish up a little bit with the Aussie dollar. So kicking it off with the global economy. Global economic growth is pretty subdued at the moment. You can see that on this chart on the left, which shows GDP growth rates for some advanced economies. So our team is forecasting that the global economy is going to grow between 3% and 3.1% in the years from 2024 to 2026. This is soft by historical standards. Outside of the pandemic and the GFC, these would be some of the slowest rates of growth we've seen over the past 2 decades. It is worth, while we're here, just calling out the US as a little bit of an exception. So growth was quite robust in the United States in the second half of last year, and we think it will have remained quite reasonable in the first half of this year, with household consumption holding up. So that's been really great for our beef exporters, for example. But even still in the US, as in other advanced economies, we've started to see some easing in labor market pressures. So labor markets were really tight for quite a long time, and you can see this on the right-hand chart on this slide, which shows you unemployment rates for these economies. And you can see that now unemployment rates are starting to just track upwards across these economies as slower growth feeds through to the labor market. Of course, much of this weakness in growth and the loosening in labour markets is a result of high inflation and the consequent restrictive monetary policy put into place by central banks. So the left chart here shows you rates of core inflation across several advanced economies. And what you can see in these economies is that inflation is coming down, but slowly and with plenty of bumps. You'll notice that core inflation in Australia is a little higher than in some other economies. So that's the green line, that's us. I'll get to why that is later. But overall, recognizing that this reduction in inflation has kind of come off its peak, along with the fact that labor markets are starting to cool, major advanced economy central banks outside of the Bank of Japan have started easing rates or are expected to do so soon. And that's what you can see on this chart on the right-hand side. You can see we've already had rate cuts from the ECB, the European Central Bank, that's that purple line, and also the BOC, the Bank of Canada, that's the black line there. The team also expects the US Federal Reserve to start easing later this year too, following some encouraging inflation prints earlier this year. So we've got slower growth and we've got inflation coming off its peak and some monetary policy loosening on its way, but what else is going on in the global economy and what else is relevant for us? Well, there are a number of risks to the outlook for growth and inflation. And the first one I'll just chat through is supply chains. We're still seeing some pretty severe shipping disruptions due to conflicts in the Middle East. On the left-hand chart, you can see that the number of crossings that container ships are making through the Red Sea and the Suez Canal has fallen dramatically. That's that red line there. And that ships are instead taking the longer route around the Cape of Good Hope, which adds about 9 to 14 days to any journey and increases costs. You can see this reflected in the increase in shipping costs on the right-hand side. Of course, this adds an upside risk to inflation. Just quickly while we're here as well, 80% of Australian canola exporters send their product to the European Union, and this is a key shipping route affecting that market at the moment. On a similar note, as I alluded to, geopolitical factors are presenting issues for the global economy to navigate a little bit more broadly. So aside from disruptions to shipping, the outlook for US economic, foreign, and trade policy is uncertain and will very much depend on the election results in November. And also the Russia-Ukraine war continues to negatively impact the supply of energy commodities and agricultural commodities. On top of this, oil markets could face further disruptions as well if conflict escalates or widens. So there's a number of risks to the global economy. But what we're going to do now is kind of place the Australian economy in this context and talk about how this affects us and what's going on at home. So turning our attention to what's happening here, the team expects growth in the Australian economy to remain pretty well below trend this year. And you can see this on the left-hand chart, which shows you real GDP growth over the year, that black line, along with the NAB economics team's forecast, that dotted line there. So the national accounts showed that GDP rose by 0.1% in the first quarter of this year, or 1.1% over the year, which was in line with our expectations. Looking forward, we do expect below trend growth over this year before growth picks up to trend in 2025 and 2026 of about 2.25% over the year. The national accounts included pretty large upwards revisions to consumer spending, which you can see on that right-hand chart there. The story around consumption in the Australian economy at the moment is a little bit nuanced. So we had pretty resilient outcomes for consumption, all things considered. But we expect Q2 growth in the economy to remain soft overall, as household budgets are still under a number of pressures. Looking forward, though, we do expect these pressures to kind of come off and for consumption to support growth from the second half of this year. So speaking of, this rebounding consumption growth should be helped along by improvements in real income. So that's that red line on the chart here. So this year, there have been a few things weighing on growth in household disposable income. And you can see on the graph here that those three things are prices or inflation eroding the purchasing power of income, that's those blue bars, income tax, those orange bars, and also interest payable, so rate rises, those purple bars. We think there'll be relief in all these three things in the future. So we're expecting inflation to continue to moderate. So that will take away the effect of those blue bars. We've had the stage 3 tax cuts, and we also expect to see some rate relief next year. I'll chat a bit about that in the future. Consumption over recent quarters has also been supported by a pretty tight labour market, though it is loosening. Trend employment growth has been pretty resilient, given the fact that the economy's been growing below trend. And employment growth at these levels has actually been enough to keep the unemployment rate at around 4%, which is still quite fantastic, although this result has been a bit volatile. Loosen a little, though, as weakness in economic activity just feeds through. So the unemployment rate is still low at 4%, which is that red line on the left-hand chart here. But as you can see, underemployment, a measure of labour market slack, is starting to pick up. So is the number of unemployed people per job vacancy, which you can see on the right. Turning a little bit more to inflation now. So inflation is well and truly on the way down. And trimmed mean inflation, which is the black line on the top panel of that left chart, that printed at 4% in the first quarter of this year over the year. Of course, around 4% is still outside of the RBA's target band of 2 to 3%. This result was also an upside surprise for us. It was above expectations. A bit more recently, data from the monthly CPI indicator that we've received for May and June showed a little bit of a further re-acceleration in headline inflation, but this is only a partial indicator. And what we care about here is the more granular information that we get from this indicator, which was actually quite encouraging. It did show there were some signs of a stronger trend easing in market services inflation, which has been a particular concern for the RBA. That being said, services inflation continues to track more strongly than goods inflation, and that's what you can see over in the graph on the right-hand side. As a result of this recent data flow, though, we have upped our trimmed mean inflation forecast for the second quarter of this year. We'll find out the result next week. And we think that over the first half of this year, there hasn't been that much further moderation in the pace of inflation. But speaking of forecasts, while we did up that trimmed mean inflation forecast for Q2 this year, we don't think that the CPI has re-accelerated. The track back towards target will likely remain bumpy, as we saw in other economies that I showed earlier. And we've got the impact of subsidies along with volatility in several components. Further out, the trajectory of our inflation forecasts remains pretty much the same. We think the trimmed mean measure will ease to around 3.6% by the end of this year and 2.7% by end 2025. The broader inflationary backdrop is also likely easing, so wage growth appears to have peaked and eased slightly, while the minimum and award wage increases also decreased in the current year. As the labour market continues to ease, it's likely that wage pressures will ease further. So where does this kind of leave the labour market? So our forecasts for unemployment are on the right-hand side. We do expect the unemployment rate to drift higher, reaching about 4.5% by the end of this year. And while population growth appears to have peaked, it remains really strong. And with below trend growth persisting through the economy, we don't think that labour demand is going to grow sufficiently to absorb that rise in population. But a little bit further along, we do expect the unemployment rate to come back down and stabilise at a bit above 4%. So we've got cooling inflation, we've got a cooling labour market, and some below trend growth. What does this all mean for the RBA? Well, the NAB team now sees the RBA remaining on hold until May 2025, before easing rates by 125 basis points over the year to May 26. What we have seen is that growth in Australia has tracked through a pretty weak period, so that low GDP result, and the labour market's cooled. These are both developments that we largely expected, but the risk of the RBA remaining on hold for longer at its current cash rate target of 4.35% really developed over recent months as the pace of moderation in inflation rather, began to slow. Given this backdrop, that is slow moderation in inflation despite the slow growth, we think that the RBA will embrace what we're calling a lower for longer approach. And by that we mean The RBA is going to have a lower peak interest rate compared to other advanced economies, but they're going to have to remain at that peak for longer. Of course, you could be quick to point out that the RBA board actually has another option available to them, and that they could increase rates further. And you'd be totally right to point out that option. But it's just an option that we think would require a bit of a planned strategy of more than one hike to ensure that inflation moderates more quickly. The strategy also runs the risk of ongoing weakness in growth and a larger deterioration in the labour market. So for now, we don't think the RBA's hand will be forced in this respect because growth is low and unemployment isn't all that far from their estimate of full employment. But overall, how long rates remain on hold ultimately depends on the flow of data. And we think that the RBA board is going to want to see a few CPI prints, underlying CPI prints, annualizing around the top of that target band before it has the confidence to ease policy settings, which we think puts a first rate cut in May. So finally, to wrap up before I pass over to John, I will just talk briefly about the Aussie dollar. The Aussie has strengthened a little recently. It's been trading above 67 US cents after being pretty range bound between 66 and 67 US cents over May and June. Our outlook for the dollar is unchanged, with the currency expected to rise to around US 69 cents by the end of the year, and then 75 US cents over 2025. The key to this outlook continues to be a broader softening in the US dollar as the economy slows and the Fed begins to ease later in this year. So you've sat through a little whirlwind 15-minute tour of the economy. Thank you, well done. I'm now going to pass over to John McKillop, and John's going to provide a view on what Heron Todd White is seeing across the property sector.
Thank you. Share my screen. Can. Hopefully that has worked. Okay. Thank you, Leah, for that. And thank you to NAB, Mark and Alison, for the invitation to speak today. I already had the introduction, so I'm just going to talk about a couple of things. Agribusiness, what the markets are doing, a little bit on the regional commercial markets as well, and then take any questions. So I will jump into it. The number of drivers that we're seeing in the property market at the moment is the sudden and quite rapid shift in the commodity prices. Obviously, seasonal conditions, because the two of those combined really affect the free cash flow. Interest rates and where they're heading and where they've been. And then the emerging markets of carbon farming and renewables are also having an impact on at the moment. So I just wanted to put it in context, and I'll just focus on livestock at the moment. If you look at what's happened in the beef sector, this is since 2008 to the current market, you can see where we've historically been, and then you can see that huge jump from 2020, 2019 through to the peak last year, and how far that's come off. And obviously there was a large frenzy of activity in that 2022 period, when people were suddenly seeing a rise in the free cash flow that was coming about, and that was driving that property market. Very similar story to the lamb market. This is the lamb and sheep market. You can see there it's gone up to a peak in 2020, 2021, and then it's had that falling off a cliff last year. We've seen a rise back in that market again, but must remember those current prices are driven by a winter market, which is always historically high because of the shortage of supply. Just interesting to look at the change in a 12-month period. That ECI is now a little bit out of date. We're above the 800 cents, so it's probably 20% above where it was this time last year. Sheep is 30% above. Wool down 25%. Wheat is down 10%. Interesting that dairy is actually still above. Sugar's down 12%. Cotton's down 16, 17%, but still it's still a pretty good price. So cotton's probably more driven by the availability of water than it is by the price. as long as it's closer to that 70 odd cents US a pound. Cost of production really is what's driving a large part of that in the livestock sector at the moment. I would maintain that producers need to have a cost of production for lambs of less than $5 a kilo in order to be sustainable in the longer term. And last year in November 23, the value was $4.60. So even efficient producers at that price were losing 40 cents a kilo. The current price of $8.09, which is a winter grid, it would leave a $3 margin if you're able to produce lambs at $5 a kilo. But what we've seen is a rise in the value per DSE, per dry sheep equivalent, from $350, $400 5 years ago to over $1,000 now. So even at that higher grid of $8.09, you're seeing about a 1.5, 1.6% return on investment, depending on your cost structure, etc. The other thing that's really happened in that lamb market is the cost of production has increased, and that's increased around labour, and it's increased around fertiliser. And I think there's just been a little bit of a loosening of the belt by a number of producers who have just, well, the price is there, we're getting $8, $9, $10 at different times, and a bit of a loosening of the belt there. So we're seeing what we'll need to see over the next couple of years is a reining back of that cost structure in order to get that profitability back into that sector again. The other one is seasonal conditions. If you look at the one on the left of the screen, you'll see this time last year, much of Queensland was either below or well below in its seasonal rainfall, based on rainfall deficits. Western Australia, particularly the Pilbara, was below, but much of that middle right through to South Australia, Western Division of New South Wales, and into parts of northwestern Victoria, we're experiencing very good seasons. And if you look at the last one from June this year, it's almost the complete opposite, where Queensland's on the whole is doing very well. The Pilbara and down to the south is doing well, but Victoria and parts of southern New South Wales are probably in a rainfall deficit and a feed deficit, which of course that won't change. So we are seeing a bit of a flip around in that seasonal conditions on the whole, which most of you would be aware of. So what's that doing to the property market? I just thought to look at it over the last 40 odd years. The grazing index, which I used to use in many different talks over the years, because I find it's the longest running index. It's an Australian Grazing Property Index from 1980 for properties over 2,000 hectares. The compound annual growth rate over 43 years is 10.2%. Now, if you add that, even if you're only returning 1 or 2% from operations, you're still looking at a combined return there of 12 to 13%. Now, you might argue it's only been 6.6 compound annual growth rate over the last 12 months. It's still off a very high base over the preceding number of years. If you looked at where those growth rates have been most prevalent, if you look at the 23-year one, you'd say New South Wales 9.8, South Australia stands out a little bit more at 10.6, but Victoria 13% over the 23 years. And if you look across that to the 10-year rate, it's 18.2% over that 10-year period. Victoria's certainly been the standout. My interpretation of that is that it's largely been a retreat to safety by many producers who are saying, well, let's get down to where the rainfall is less variable, particularly in those western districts of Victoria. So I think we're seeing a retreat to safety. Tasmania, oddly enough, hasn't had as much as I would have thought, but it's still been very solid at 12%. The other trend that we're seeing is, and it's to be expected, the national number of sales on your left-hand side is very much in a downward trend. What we're seeing is by and large a reversal of a very old legacy policy that happened after World War II, which was a soldier settlement scheme, where large properties were cut up into, in many cases, the 640 acres being the 1 square mile. Over the years, a lot of those have been aggregated, But we're seeing now a massive shift towards reconsolidation of large properties. And that's not just the corporates coming in. A lot of that is what we'd call the family corporates, those that turn over more than $5 million in any one year. And I don't have the numbers in front of me because I wasn't completely confident in last year's numbers, but as best I can figure out, and I followed these numbers for a long time, in 2022, we passed the 80-20 rule, whereby 20% of producers were responsible for 80% of the farm gate output. And so in other words, 80% of producers by numbers produce 20% of the output. It's just a massive consolidation. And that's what's happening now. And you look on the right-hand chart where you look at it and say, well, the value of the total transaction is just very much on an upward trend. Number of sales down, value of sales very much rising up. And that's this large play around these corporates markets. The interesting thing about that corporate market, and you had a reasonable involvement in it, is that on the best numbers I've seen, about 60% of those are actually family corporates. The other 40% are the two corporates with external shareholders, be it living in Australia or externally altogether. So the rise of the family corporates we're seeing is probably one of the biggest trends in agriculture at the moment. You look at some of the property sales, this, and again, this is from 2023. We're not seeing a lot of evidence yet of any drop in values. We're seeing some, well maintained, and indeed some at that larger scale to be increasing. If I look at Brun Chili, one that I was personally involved in there, went to a large family private that most people would be aware of, 107 million, well and truly at or above, the historical trends. The Kimberley portfolio, 300 million, at or above. So again, we're not seeing any evidence of a deterioration in that market. What we have seen is the impact of, and again, I'm focusing very much here on livestock, but similar trends would be in other sectors. If you went back to 2014, we would say $6,000 an adult equivalent is about where the market is. You then saw this massive rise in the ECI, which is the blue line, the ECI, which is the green line, as I pointed out before, from about 2020 onwards. And then you've seen the rise in the blue line being that up to $20,000 an AE, where it's peaked in recent times. Now, there's two things that will emerge from that. One is that you've seen interest rates go up, and you've seen the Eastern Young Cattle Indicator, the ECI, coming back down again. And now that convergence, they converged back in 2011, and they're beginning to converge. Looks like they may well converge, subject to Leah's views on the interest rates, but certainly the ECI, they're certainly coming closer towards each other, which may be a pinch point and a pain point for a number of producers who have got a large debt burden out there at the moment, where they may have borrowed that at 3% and they're now closer to 6% or around those figures, based on a cattle indicator that was well and truly over the 1,000 cents and is now in the 800s. The key drivers of property values tend to be free cash flow, how much money is in a farmer's pocket. And that's really a combination of commodity prices and seasonal conditions. It also depends on access and cost of capital, and that's in most people for agriculture, that's debt, although it can be equity in the case of the corporates because they look for competing uses of that equity. And the third one is a change in land use. And we're certainly seeing that at the moment, where we're seeing carbon farming coming into its own. Carbon farming, for those who aren't too familiar with it, involves either changing the way some agricultural activity is performed on the land or implementing new activities that are known to either store carbon or sequester carbon. Carbon management plans can be really put into two categories: emissions reduction, avoidance, in other words, not emitting something that you would have otherwise emitted, or sequestration. And that is really in two forms. Primarily, it's really above the ground, being in trees, or it's below the ground, being in the soil. We're seeing that starting to impact the market. But look at this one. This was around the Burke region, Western Division, Western New South Wales. Purchase price 9.6 in October 23. the value of that property, if it wasn't for carbon, would have been around 8. It sold for 9.6, giving a carbon value there on a net present value of 1.6 million. So, you know, on a percentage wise, it's 16%, it's nearly 20% premium over and above the market for its carbon potential, other than it would have had for its grazing potential. The other one is the renewables market. And again, this tends to divide communities as much as economists, I'm sure, and those involved in the sector. It seems that if you have wind farms or solar panels on your place and you're deriving some income from it, you're reasonably happy with it. If it's on your next door neighbours and you're not getting any benefit, then it's not so happy. But we're seeing this market really emerging into its own market now. His particular sale that around $16,000 a hectare of value added for panels, that's working it back on a 7% discounted rate. Wagga, similar things. We're seeing that market. You see that large screen there we've got just north of Bowen, just north of Wagga in the Bowen industrial region. $31,000 a hectare, been $19,000 value added just for the panels. In terms of longer term leases, you know, it seems to be settling around that, I'm going to say around that $1,000 a hectare basis. We've seen some as low as $741 and some up to in the Northern Territory of all places at $2,000. So these markets are emerging. It doesn't seem to be a standard costing for them, and each one is individually negotiated, and there is a lack of transparency within a lot of these ones, where people are prohibited from actually disclosing what they are paying or being paid by these leases. So a lot of this is just trying to extract that information out of people off the record as much as possible. So in summary, and I think I agree with Alison on this one, the market remains strong for premium properties. Talking to a number of the agents over the last couple of weeks and just say, what are they feeling? Because the trouble with valuations, you're very much backwards looking, trying to get a feel from the agents about what's coming through in terms of inquiry. And they're saying that, look, there's lesser demand for those second and third tier properties. The family buyers remain very active, although very much focused on that quality end. Corporates are struggling a little bit by returns, but the corporates generally tend to be behind the family operators by 2 to 3 years, both on the upside and the downside. And that's really just the time period it takes for the corporates to get into the market and for that and to do a deal and then get back out of it again. The good thing is that banks, and I'm going to say NAB in particular, are very much out there looking for business and driving this for quality operators, looking for quality properties. So I think there's some good news there that I can see that cost of capital hopefully coming down, but also that availability remaining there for those that are good operators and buying the quality properties. Industrial, look, well and truly outside my zone, so I've called around a couple of the valuers who know far more about this than I do. So this is very much focused on the regional markets, and we had valuers from Port Douglas, Cairns region through to southern Australia. Seems to be that generally the industrial is probably performing the best. Now that's followed by medical/health, and interestingly enough, in many regional centres, it seems to be driven by the expenditure on NDIS. After that, we're seeing office space, and then retail is probably lagging behind. Very much a two-tier market in that retail space, where you're seeing national tenants from the likes of Bunnings, Woolies, Coles, etc., being highly sought after. And of course, that's having an impact on the smaller retail, the strip retailers in a lot of those centres where they can't compete with the large Woolworths, Coles, Bunnings, etc. And those shops are now giving far less yields than they would have a couple of years ago. Office vacancies increased across regional markets as we see more and more people working from home. Retailers, obviously, as I said, has been impacted not only by those other retailers coming in, but also by the cost of living crisis, with people retreating to lower cost providers. Industrial supply remains low, and that's largely a result of just the inability to grab materials and labour in the market. But what I understand from that is that a lot of that market is actually still being driven by owner-occupiers putting it into their super funds. The mechanic who buys the industrial shed that he or she was leasing, so that those repayments go back into the super fund, almost to the point where yields don't matter in those cases, and those margins are being squeezed into those markets, which suggests that perhaps at some point there may be a correction in that market as people exit out of their super funds and offload those industrial sites. And obviously increased construction costs are compounding the supply issue, and that where people just can't get labour and can't get materials. So that's really a quick wrap up, and I think we'll have a question session later on. Thank you.
Excellent. Thank you, John and Leah. So you've just stopped sharing your screen. Thanks, John. Yeah, you have. That's great. Now we might just kick off into the Q&A sessions. We actually had a couple of questions that were actually submitted before the event. So I might kick off with those, and if there's any more that flow through, I'll pick those up as we go through. Leah, this one's for yourself. Does the Reserve Bank have enough tools in this modern economy to slow inflation when only 30% of people have home loans now?
Thanks, Alison. It's a good question. So what I would say to it is that when we're thinking about the effectiveness of monetary policy, the key point to keep in mind is that monetary policy is a blunt instrument. And this means that the central bank cannot fine-tune who it impacts or how it works. So in that spirit, I would say it's important to remember that mortgage rates are just one method of transmission. There are other channels. For example, high interest rates also affect the cost of lending faced by businesses. So as for its effectiveness at the moment, a cash rate target of 4.35% seems to truly be restrictive territory for us. And what we are seeing is that these high rates are slowing down the economy and working to bring supply and demand into a better balance. And we can see that inflation is coming down.
Excellent. Thanks, Leah. Now, this question could be answered probably by either John or Leah. Just in relation to the impact of cost pressures on both agri and regional property markets, and specifically some of the cost pressures that they asked about were interest rates, I think, which you've already probably covered, Leah, climate risk and the export market. Someone want to jump in there?
I'll go first on that one, particularly on the export markets. Look, we're seeing a lot of some good news out of China in terms of the re-establishment of some markets back into those, with wine and particularly some establishments in the beef processing, lamb processing sector gaining access again. So I think there's some bright lights on that. I think there'll be a lot of lessons learned out of that, where people won't be putting all their eggs in one basket in the Chinese market anymore. I think that's been a good lesson for a lot of people who were probably, well and truly over that 30% mark, reliant on China. So I think export markets remain good. I think we are seeing a favourable supply and demand metrics coming up for the red meat sector. So I'm fairly confident on those. Interest rates I've talked about, where I think there's a lot of people will be squeezed at the moment. And from what I'm hearing is the secondary lenders, being the non-bank lenders, who have lent probably on assets rather than cash flow, are now actually calling in a lot of those loans, and maybe not quite going mortgage in possession, but are starting to put pressure on some of those purchasers to offload those assets, particularly the horticultural sector is what I'm hearing.
Yeah, interesting. Leah, did you have anything more to add to that?
Yeah, I would just echo what John was saying about the export market. So I would say it's looking pretty good for Australian producers. I'd point out that while I kind of talked about the fact that growth is slowing across advanced economies generally, growth outcomes across our major agricultural trading partners are pretty varied. So it's been relatively okay in the ASEAN 5 countries, so Malaysia, the Philippines, Indonesia, Singapore, Thailand. And along with Vietnam, those account for about 20% of our agricultural exports. Similarly, the US's healthy household consumption results have been supporting beef export demand. And as he said, in China, although growth is slowing, there's certainly that tailwind of the import restrictions on Australian agricultural commodities coming off. As far as other cost pressures on businesses go, so we're seeing in the NAB business survey that cost pressures are still elevated for businesses. A lot of this is driven by labor availability shortages. This is particularly true for agri and regional businesses. But there again, as I said, the silver lining is that we do think labor cost pressures have probably peaked. Another thing I think that's worth highlighting for this customer base is probably the upside risk to some energy prices in the future due to geopolitical tensions and supply chains. So particularly natural gas, which is a critical cost component for nitrogen-based fertilizers. And I think ABARES estimated that last year, fertilizer and some other chemicals made up. Keep an eye out for.
Thanks, Leah. And there's another question that's come through just in relation to the outlook for commodity prices. Do you have any views in regards to that?
Give that for Leah, that one.
Sorry, what was that, Alison?
There's another question that's come through just in relation to commodity outlook, the outlook for commodity prices.
Sure thing. So the outlook for commodity prices in Australia is overall prices should be up, but it's a little bit mixed between commodities. So if we take the two key kind of export markets for us, so livestock and grains, it's looking like upwards movement in livestock based on more favorable seasonal conditions and that healthy export demand, particularly as meat in frozen inventories overseas is run down in East Asia. On the grains front, though, we are seeing a kind of a softening in global grains prices due to that grains glut. So the market kind of continues to be dominated by weather developments in Russia. So more favorable weather is suggesting that there'll be a larger Russian export than previously expected. And this will increase global supply of grains, which will put downwards pressure on those global prices. And Australian wheat prices especially take their cue from the global market.
No worries. Now, I think you must have just dropped out briefly there before, Leah, but someone has actually just asked, what did you actually say before about nitrogen prices? They just missed it.
Okay, no stress. I was saying that natural gas is a critical cost input for nitrogen-based fertilizers, and natural gas prices have gone up a little bit recently due to political tensions and supply chain issues happening in the Middle East, although not anything like what we saw in 2022. And overall, fertilizer prices are expected to fall over the year on the back of increased global supply.
Excellent. Thanks, Leah. Now, John, this one's probably more for you, and there's been two questions to come through, one that was submitted prior, one that's come through live, just in relation to water prices. Now, we've had someone from who's in the MIA zone who wants to just get your views on permanent water and whether it's undervalued compared to local land and water in northern New South Wales, and someone else who just wants a comment on general water values. So I'll let you take that from there.
Thank you. And thanks to Adrian for the question. You know, as Adrian would know, Adrian Swogger would know, you know, we've seen a massive rise in that, particularly that Namoi region for the deal that I was involved next door to you a couple of years ago, where we put, I think, $4,500 a meg on that water. The most recent sales I've seen have been closer to 7.5 and 8. Now I'm not sure what's behind those, whether they were smaller parcels, but you know, if that's any indication of where the market is, and that's a 50 to 100% jump in the last couple of years, which you know, it goes back to that point about what drives these things, and it's largely free cash flow. And if a run of good seasons where cotton growers in particular have had, you know, $700 a bale prices, and you've had, you know, and you're now putting off, well, in your case, Adrian, I'm sure it's closer to 15, 16 bales to the hectare, but you know, if for the average producer at 12, it's some pretty good money in it, and it's just putting free cash flow into people's pockets and largely driving that value. Is it overvalued? Well, you know, time will tell whether it's overvalued, but I just feel holding water, particularly in those quality regions like the Namoi, is just going to be, you know, it's just going to be a good protection against inflation in the longer term and a good way to create wealth. So is it overvalued? I don't think it is. I think that the returns are there. You know, cotton's just continues to stand out as a model industry that just continues to improve its water efficiency, its yield returns. Just, you know, as I say now, if I went back 20 years ago, 7.5 bales to the hectare was probably where you needed to be. If you're not in the game now, 12, you're not really there. You're not serious about it. So, and compare that to the MIA. I was talking to the valuers down in Mildura earlier today about this question, and he said, look, it's really not a comparable market because you're not going to see a massive influx of grape growers from Mildura suddenly deciding to head up into the Guarda or on the Namoy, the McIntyre, and you're probably not going to see a massive, exit out of the Guarda, Namoy into that MIA region to grow cotton. I mean, we are growing cotton there now, and it's becoming more and more a thing, and it has been one of those land use changes that has driven those values. But the yields aren't as much. There's greater risk around winter rainfall and those crops getting harvested in June, July, and so there's certainly not. It's not an easy market for area for cotton to grow into, and cotton is largely driving those values on those water markets. I'm not talking about horticultural high security water. I'm here talking about general security water, which it's when it's available, you grow the most valuable crop, and that happens to be cotton, or the most valuable legal one anyway. And then you can shut down your operations if the water's not there. So.
Excellent. Well, thanks for that. And we're just on time, actually, so I might wrap it up from there. So just wanted to say a massive thank you to John and Leah for your insights today. And just wanted to say thank you to all of our guests on behalf of NAB Regional and Agribusiness. So that'll be all for today. Have a good night, everyone.